I'm thrilled today to have one of our very first guests on Honest Money back on the show again, the Finance Ghost. Thanks so much for joining us.
Yeah, Warren, thank you so much for having me. I think I've been on twice before and both were great experiences, and it's amazing how many people listen to Honest Money. I remember after I came onto the show, a lot of people said, I heard you on Honest Money, I heard you with Warren. So yeah, it just shows you guys have got a very nice listener base, a nice, consistent and large listener base for that matter.
Yeah, thank you very much. I think we're privileged with the listeners that we've got. We were talking off air just before this about the rough and tumble of Twitter and the cancel culture, etc. And I think we somehow have been very privileged to get great listeners that give us good feedback, but not so much on the rough and tumble, which I really appreciate.
I actually have a funny story for you, Warren. So when I came onto Honest Money the first time, I was still working a day job at that point in time, and someone I work with actually said to me, I listened to this really cool show the other day with this guy, the Finance Ghost. And I said to him, oh, really? And what did you think? And he's like, wow, it was really cool. And we started to carry on, and he thought, no, hang on. Because now he's listened to the podcast. He's now listening to me talk. And I said to him, yeah, no, it is me. His mind was blown. It was hilarious. I think he was one of the first guys who kind of found out, so to speak, and it was through your podcast. It was such a fun experience for me that's how he found out, because it was like this absolutely genuine emotion and reaction of, oh my gosh, it's you. It was brilliant.
Classic. So today I wanted to talk about our kind of a recurring theme in the world of investments, which so just a little bit of de-jargoning, because it's Honest Money, we hate jargon, but there is this conversation always around what the industry calls active investing and then index tracking or passive investing. So just very quickly for our listeners, active investing would be when somebody, either an individual or a company, decides they're going to choose individual shares or individual bonds, individual properties, whatever the deal is, and put them together in a portfolio with the hope that they're buying investments that will do that will do well for them and potentially will do better than the stock market, or at least meet a specific objective that investor has. So the active investing is probably the oldest form of investing that we have, and certainly been around for hundreds of years. And stock markets were built on this. A lot of the big asset managers, both in South Africa and around the world, are classified as active managers. And then the index investing, in contrast, is when you say, I'm going to buy the whole stock market. So in South Africa, I'm going to buy the all share index, or I'm going to buy the world index, and I'm going to allocate money there. And all I really want to do is get the return of the whole stock market. I'm not concerned about trying to do better. I just want to get the performance of the market as cheaply and as effectively as possible. So jargon-wise, that's the kind of two themes that we're always faced with. And I think, I don't know what you feel, Finance Ghost, but for me, there's quite a lot of artificial kind of conflict around this, where people want to make it a fight and say it's an either or. You must do this or you must do that, and all active investors are evil and all index investors are idiots. And I think it's too simplistic, firstly, but secondly, it's too exclusionary. I don't think it's an either or.
I completely agree. This isn't an English football game. You don't have to pin your colors to the wall on either side. I think you can use both. And I think it's probably correct to use both. I certainly do. And I think it would be silly, to be honest, to say that one is correct at the exclusion of the other. I would agree with that.
So I think for today's show, I don't really want to focus on the merits of either. I think it's to me personally, I've written about it, I've spoken about it. I believe both have merit, and certainly in my own money and in my professional life, that is what I do. I combine the two. But I've got much more experience in doing this on a large scale for a business and at a large level. So I really wanted to talk to you because I know this is something that's close to your heart, especially the individual shares and the index investing. And I thought it would be great to have you on so that you can maybe we can discuss just how do individuals do this with their own money and kind of get the best of both worlds in the most effective way possible.
Yeah, absolutely. It's such a powerful tool, and there's no reason why you can't do it in your standard sort of brokerage account. And you can do it on local stuff and international, which I think is really important. And what's also interesting is you can buy local ETFs that track international themes and indices as well. So there's really just this world of opportunity by combining the two, I think.
Okay, so let's kick off with let's say the starting point. You've hit a brokerage account. So the starting point for an individual will be that they need to open a stockbroking account or a brokerage account somewhere. Does it matter where it is?
Technically, no. I mean, look, I use Easy Equities. I'm happy to say that that's worked very well for me, without a doubt. You can buy a lot of the ETFs on there. You can have your tax-free savings on there. You can execute a lot of the stocks locally and internationally. But ETFs are exchange-traded funds. That's actually what it stands for. So as long as you've got a brokerage account, you can basically put in a bid and be the proud owner of an ETF.
So from my perspective, I think what you're looking for when you choose an account is simply a place where the administration is going to be very good. Your ability to buy investments should be as seamless as possible, and then critically that the costs of transacting or the ongoing costs are as low as possible. I think all the banks in South Africa seem to be kind of moving into this space. Some of them have been in it for a long time. Others are going there. A lot of the kind of investment houses tend to stay away from opening brokerage accounts, but then you get sort of much more modern platforms like Easy Equities as well. So I would just say, do your homework, make sure that you know what you're paying, but then beyond that, don't worry too much about it. It must just be easy to transact. I don't know if you've got any other criteria one should be looking at.
No, to be honest, that's about it. I think that works. Beyond that, your hardest decision is what you buy, not who you buy it through.
Well, I'm glad you're going there. So how do we do this? If I'm an individual, I don't have hundreds of thousands or millions to start. What's the way that one approaches an exercise like this?
So the way I look at it is ETFs bring you what's called beta, which is basically the market return in a specific index or a specific sector. And ETFs can be really broad. It can be stuff like the JSE Top 40. It can be the S&P 500, or it can be really interesting. It can actually get all the way down to themes like gaming. Warren, I can see a Take-A-Lot box in the background there. So e-commerce, I would wager that somewhere in the US is an ETF that is an e-commerce theme ETF, if that's something you find interesting. So, the starting point, I suppose, as with every portfolio, is to say, well, what sort of allocation do I want? I suppose global versus local is probably the starting point. I mean, you're definitely much more of an expert at this than I will ever be, but that's certainly the way I think about my own money, is how much do I want there versus how much do I want here? And then beyond that, ETFs are a wonderful way to get broad exposure quickly into themes. So if you believe, as would be correct, that long-term the best way to create wealth is to be in the market, then buying broad market exposure is a great underpin for any portfolio. Beyond that, you may want to start buying themes. You may want to start making single stock decisions. But that broad underpin of just putting money in every month into, the ETFs of your choice is really not a bad way to go. It's going to give you literally the market return minus hopefully some very small fees. And of course, that means some years will be good and some years will be bad. But, over 10 years and 20 years and 30 years, it will average out to a compound annual growth rate that is much better than you will get anywhere else, really. And that's the trick. So for me, that starting point is, international versus local. And then I would say an allocation of how much do you want sitting in broad market exposure versus how much are you willing to allocate to themes and more interesting stuff, and then how much are you willing to allocate to some of your single stock punts. And that should probably vary based on your experience and ability, honestly. I mean, everyone gets it wrong, without a doubt. I've got a couple in my portfolio that are not pretty, but you've got to start somewhere. And I think if you're new to this, then the trick is to just read as much as you can, and when you feel good about a single stock opportunity, make an allocation, but start small. Have a nice small amount in there and just see how that goes, learn from the experience, and let your ETFs work magic around that.
So let's just expand on that a little bit. So when someone's going to buy, when you were talking about broad market exposure, in my mind, in the South African markets, there are probably two kinds of ETFs that provide that for the JSE. The one would be the top 40 index, or the alternate to that would be the top 50 index. And I actually think that they'll make a lot of noise, those providers, about the big differences between those two, but truthfully, the differences, I think, over the next decade will be quite small. So I think that you could probably buy either of those two, and lots of companies will provide those. It's not that only one company provides a top 40 index, but I don't think you need more than that. On a global basis, I think it's a little bit more interesting. So the index providers do make this very confusing. So you get something called the MSCI World Index, and you'd think that the name would say it all. In other words, that's the world stock market, but in reality, that's only the developed markets in the world. It reminds me of the Americans when they have their American championships of the baseball series. They call it the World Series, as if no one else plays baseball. But the World Index, unfortunately, is not the whole world. You get another index called the All Country World Index, and that's the one that would give you the broadest market exposure, because it incorporates the world markets as well as the developed markets as well as the emerging markets. And then you get slightly more kind of tweaked in global indices. So for example, I know CoreShares launched one not so long ago, which is also covering the world, and it does have a good exposure to the global markets as well. But it's not done by MSCI. I think it's done by Standard & Poor's, if I remember correctly. So I wish I could remember the name of it now. Obviously, as I'm talking to you, it ran straight out of my head. But there are some very good world indices as well, and I think, when you're saying broad market exposure, I think that's I agree with you 100%. I think those are very good, and you don't need to be too fancy. You don't need to go and say, I'm going to replicate the world index by buying America, buying Europe, buying Japan, buying emerging markets. You can literally buy the world index and be done. You don't have to worry about it. It keeps your transaction costs down.
Yeah, because that is the one thing, as I've certainly learned in the past 2 years with a single stock portfolio, and this is where fund managers have a complete advantage here, is the rebalancing. Because if you rebalance as an individual, you pay tax. So it's obvious, well, it's an unfair statement. Like for me, at times it was obvious when stuff was too big and too expensive, but you sit and go, oh, if I trim this now, I'm going to be paying tax on this amount, and then in any event, I'm giving a big chunk of it to the receiver, and do I really have a long-term view? And then what you end up doing is watching a bear market take you down 35%, and you knew it was going to happen, but you didn't sell because you thought, well, the tax, and then when do I jump back in? And so that's where fund managers have it good. You can kind of buy and sell and rebalance if it's in a structure that isn't taxable, and that's where they should definitely outperform retail investors. And the other issue, that's where ETFs have a nice advantage, because they're constantly rebalancing, without you having to do it yourself. You're not selling your ETF just because one business got too big or too small or whatever. When those ETFs are rebalanced, that's happening for you, which is another advantage of passive, I think.
So I'm going to put you on the spot a little bit, because where my knowledge is never strong and my faith in myself is never strong is the choosing of individual shares. I always feel like I'm almost more lucky than skillful when I've done it over the last 25 years. So for me, if we said, for someone going down this path that started on this journey, my suggestion, so I'm not putting words in your mouth, would be that at the very least about half of what they invest should be in the broad market space to give them the protection. So let's assume that they do that, and then they've got the other half of their savings and investments to put into individual shares. What's the sort of guidelines that they should use in terms of how many shares should they have? How many, I guess the one comment is you don't want to just take half your money and put it into one share, because that's huge risk. But at the same time, you don't want to spend your life watching all your shares, so you shouldn't have 100 shares. So is there sort of a lowish number, the minimum number, or a larger number, which is the sort of maximum number that individuals should be looking at?
So opinions vary on this massively. I mean, you get people who love high conviction portfolios, and they'll hold 6 stocks in high, percentages to each one, and they've researched those things inside out, and they believe completely in them, and they see themselves as experts. So that's not me. I'm the polar opposite of that. If anyone's read any of Peter Lynch's work or that kind of stuff, he had hundreds and hundreds of stocks in his portfolio. That's also the other extreme. But I think what I personally have found helpful is if you just keep your allocations relatively low, so I think my biggest one is probably about 3% of my portfolio, then if you're right, great, but if you're wrong, you're okay. It's not ideal. It's not nice to watch Alibaba be 60% down, but I'm really glad it's 60% down from 3% of my portfolio and not from 15% of my portfolio. So the thing is, I love stock picking. I love everything about the markets. I mean, that's what my life revolves around now. So for me, it's not just a wealth creation tool. It's a hobby. It's an interest. It's a career, actually. So, for me, I'm watching the markets all the time. I'm reading all this stuff all the time. So it's easier to have a wider portfolio. And I kind of back myself that if I've picked, 30 or 40 or 50 stocks, I just need to be right on like 80% of them and not too badly wrong on the rest. I mean, if you're right on more than half, you're probably doing okay. So I just strongly suggest, I can't say the word advise, Warren, but I strongly suggest that people don't go the super high conviction route, especially in a world that is so uncertain, and sometimes the markets are just so divorced from reality. I mean, everyone can see what's happened in the last couple of months. Inflation is absolutely rampaging through people's equities portfolios. Interest rates are on the way up. There aren't too many places to hide. But if you were in one or two of the companies that got really smashed, you can be 60% down. And then you run away and lose all interest in the markets, and you've actually done yourself an unbelievable disservice over the next 2 or 3 decades, because it will be okay, provided you've made sensible decisions. If you YOLO'd into Zoom at $500, it's probably not going to be okay. But that's why you shouldn't do that stuff. You should be sensible. You should try and be diversified, and also don't just buy one sector. Everyone became obsessed with tech during the pandemic, as though everything else, like property funds suddenly don't exist anymore, and mining's gone, and industrials and FMCG. Like, there's a whole world of cool stuff out there. There's a big world beyond just the tech companies.
Yeah, I think I think you touched on so many important points there. I'm going to track back to the first big one for me is that maybe one gem there is don't buy a share and let it become more than sort of at the start 3% of your portfolio, because I think you're right. 3% is meaningful if that share over a 5 or 10 year period, doubles again, over a decade, then it could become 6 or 12% of your asset size. So starting out at 3%, I think is very good idea. The question there will just be, at what point do you trim that? You mentioned the word rebalance earlier. So I think it's important to say, well, I'm going to start at 3% if I believe in a share, but I won't let that share become more than X of my whole portfolio. My own sense of this, I'm again not going to put words in your mouth, is I think you shouldn't let an individual share become more than 10% of a portfolio if it's done that through growth. I think when a share goes from 3% in your life to 10%, taking profits when it goes above 10% and allocating that money elsewhere, for me, is sensible discipline. It means that if it does lose 60%, you've hopefully made good money over a number of years, and then it's going from 10% down to 4% of your portfolio again. If my maths is right, there's no guarantee that works. So I think that is a nice key point. And I think your second one is, having a high conviction in a sector is okay, but that shouldn't mean that you allocate all of your money to the sector. So saying, yes, okay, I've heard the finance goes 3%, that makes sense, I'm going to put 3% per share only into tech shares, is an awful idea. You need to be, I think the investment markets are great. They're a bit like toddlers. Parents of toddlers will tell you that they are enormously humbling because they'll always say and do things that embarrass parents at the worst possible moment. And so the same with the market. The moment you think you understand markets perfectly and you can forecast where they're going to go and what they're going to do, the market will show you with no uncertainty that you haven't got a clue. And I think starting out, you need to say, I know I don't know. And I think you made a really good comment there that if you can be right more than half the time, you will do well as an investor. I remember reading about Sir John Templeton, who's got a big asset management firm named after him. And he said over a multi-decade career, he thinks he was right 51% of the time. And he was hugely successful. So if you're going to invest and you have a strong conviction in tech, as an example, then that means allocate some money there, but also allocate to sectors that are the complete opposite of that, because you might be wrong. And certainly, make money when you're wrong as well is not a bad idea. So I think that the diversification of investments is not just about individual shares. It must be about different sectors and also then different countries, different economies, because South Africa, to allocate all your money here because you know it well and you know the companies well here, there is some logic to that. I agree. You've got an innate advantage compared to someone sitting in Australia trying to invest in South Africa. But all of the shares would have an overlay, which is that they are related to South Africa and our economics, our dynamics, and you need to take advantage of the emerging markets elsewhere, developed markets elsewhere as well. So if you're going to go the individual route, make sure you've got a proper spread, I think is really key here.
Yeah, and if I can make two comments on that, if we've still got time. So the one would be, traders will tell you cut your losses, let your winners run. And obviously trading and investing is not the same thing, but I've certainly found that so much of it is just your own psychology. And I end up worrying, or I end up trying to cut the things that have done so well because you think, this just can't carry on. But then you believe and hope and pray that the one that's going badly gets better. And then what ends up happening is you cut the winner and you kept the loser, which is just obviously completely the wrong way around. So personal emotion is just such a huge part of this game. So for me, with letting things get too big, I've had some real winners in my portfolio. I just look at them and go, well, this can keep winning. Unless it can't, in which case then happily I'll cut it. But if nothing's changed, if the fundamentals look good, what I need to learn to do is rather get out of the way of things that are going wrong than focusing too much on my winners. Personally, that's the one comment. And the other thing you raised there, which is absolutely right, is the familiarity bias of the local market. We know the companies, but we must not forget the stream they are all swimming in. I think where the JSE is incredibly powerful is that local investors, and I'm going to use the word traders here because I think it lends itself well to that as well. If you use a bit of a swing trading strategy, which is, shorter term positions, so you're not day trading, but you're holding for like a month or a few months, you're looking for dislocations. All the banks have done well except Nedbank. Well, there's a logical reason Nedbank might catch up. So just buy a bit of Nedbank and see if it catches the rest, unless you strongly believe it won't. Those kind of things you can make great money on. You can really do very well year in and year out if you know what you're doing. But that's not just something where you take your pay slip at the end of the month and you go, okay, let me pay myself first, let me put some money in the markets and have a go. You need to really be watching the markets closely for that. But that's where the local knowledge becomes so powerful, because these companies, you can see the dislocations, you can do the swing trading, and you're out of the way. You've banked your money before the problems of the South African economy over 10 years knock that stock. You're looking to make 5 or 10% in a short period of time and do that 4 or 5 times a year. I'm making it sound easy, and it's not. It's obviously not. Otherwise, everyone would do it. It's just a style of trading that it's a little bit of a hybrid of trading and investing, which I personally have learned about and found really interesting, actually.
Yeah, I think I'm enjoying your risk warnings that you put on, the health warnings that you put around that, because for someone like me, my psychology doesn't work well with trading. Not saying trading daily or even weekly or monthly, but just, I want to do a lot of homework on some high quality businesses, put them in the back drawer and forget about them as much as possible. Because if I look at this stuff, I worry about it. So you're right to say, it must be attached to your own style and your own preference as well. And I think there are people out there that can kind of hold their own rationally. They can think more clearly and less emotionally around shares, and they might be predisposed to both mass murder and investing, because apparently psychopaths are really good at trading as well. But I'm not saying you're a psychopath, Finance Ghost. But
mass murder, mass mart. It's all the same thing really on the markets at the moment.
So I think you've got to be unemotional if you're going to be in that space, and I think that is a key point. I also think we need to just touch on investing when the world falls apart, because I think you made a really powerful point, and it's probably quite relevant for the next months. Is when these kind of podcasts and the mass media are going crazy about blood on the streets and these dire predictions that the world's never going to get better again because there's so much going on. The one thing there is, if you're an individual investor, you've got such an advantage in a time like this, because your time horizon is unique to you. You're saying, I'm going to invest for the next decade or 3 decades. So if I buy an index or a share that's down because the world markets are panicking, and I can get that business or that stock market at a great discount, I don't care about what happens over the next 2 years. I worry about the next 2 decades. So I'm not going to be influenced by their mass hysteria. I know I've been given a great chance to buy something at a heck of a discount, and then I'm going to buy it and forget about it and take advantage of everyone else's hysteria, and I'll make money over long periods of time. And I think we probably have a lot of content coming out of kind of financial education for the next 2 decades about what's gone on for the whole of 2020, 2021, and I think 2022, because I think we've seen a lot of really irrational behavior on markets going up for no reason, and then markets going down too far. I think it's at the moment, I'm not saying that markets are at the bottom. I think markets can always fall more than you expect. but I do think it's giving us a buying opportunity of note in lots of great sectors. It's not just, the tech sector because it's fallen. I think there are lots of great shares that will do very well for a very long period of time.
So my one comment on that would be when you look at the tech sector at the moment, the one thing to be really careful of is, we've seen the Apples and Microsofts of this world fall to the same trailing multiples that they were trading at pre-pandemic, which makes it look like, okay, it's time to jump in. I personally think there's still some more downside to come, but obviously it's really hard to call these things just because of the impact of inflation on a lot of the wages of these really high-paid developers and sort of IT, geniuses sitting in America. They want to get paid big bucks, and that is putting a lot of pressure on margins of tech companies. I love companies like Apple and Microsoft, and they are core to my portfolio. Microsoft is my absolute favorite company in the world, but a lot of the marginal tech, I still don't think it's fallen enough. I mean, we did a show on Shopify and Magic Markets Premium a couple of weeks ago, and that thing's down like 60 or 70% from, I think, this year. Honestly, I think it could drop another 50%. You can make a case that it is not over yet. And it's really hard to believe that when something's down that much that it can still halve again. But mathematically, I saw a wonderful tweet, I think last week. It said, mathematically, something can halve forever. And if you just let that sink in, you realize that technically speaking, when you buy in at any price, it can still halve from there. It's just the maths. So it doesn't matter if it's fallen 70% already. You've got to look at it and say, okay, what can it do from here? And I think it's that buy the dip mentality, very much sort of an overhand of last year, and I think a lot of retail investors have learned the hard way. Buying the dip is cool, but just make sure that it's dipped enough. And then, yes, it's a wonderful, wonderful buying opportunity if you can pick those, especially with a long enough time horizon, then your entry price becomes less important. But if you can get it right, even better. It's just really fun. This is what makes the market so great, right?
And there are so many styles to investing. My own preference, if I'm going to buy individual shares in a falling market, is I'm looking for companies that are sitting on lots of cash, have very strong balance sheets, have very little debt, have the ability to kind of earn money and protect their profit margins in some way. Warren Buffett always talks about find a business with a moat. And I think maybe, if you look at a Microsoft or an Apple, there's no reason to say that they would be around forever. That's not, no business has the right to exist for forever. So I'm not saying that, but I think, someone like me who has bought iPhones since they were first released, it's going to be really hard for me to shift to a Samsung no matter what, almost. And so, that pricing power that Apple has on their products does give them a form of a moat, but not to say that it's permanent. And I think the same with Microsoft. We're sitting here and I'm looking at my screen, and all around me are Microsoft products on my laptop. And I think that that's the key, that if that's still the dominant platform for a lot of the world, that they have the ability to keep earning even when economies are doing badly. So for my own sense there, I'm always scared of a business plan. I don't like buying companies that are projected just to grow forever. But I think when you look at a company that's got dividends, that pays dividends, that has very little debt, sits on a lot of cash, when everyone else is struggling, those are the companies that can firstly buy competitors, which is great, or they can outcompete their competitors so that they destroy them. This is Darwin at work. This is about the survival of the fittest. So I agree with you. There will be lots of companies out there that have fallen. Possibly they didn't have the right to exist, or if they did have the right to exist, they didn't have the right to exist at very high share prices, and those ones are going to be found out. But there will be great companies that have fallen that will be around and that will survive this sort of economic headwinds very well, and watch the space over the next decade when they start to deliver well again. I think I have that same sense about South Africa. There's some great businesses in South Africa that have gone through the Zuma years that have been kind of, only had headwinds, and the management teams of those companies are literally the fittest, strongest management teams around. And so when we get any kind of economic assistance, companies that have only really had, economic headwinds and they suddenly have no headwinds and maybe a little bit of a tailwind, watch how they do. They will perform incredibly well. I'm not saying when, I don't know. I can't make that prediction, but I think there is a lot to be excited about when you're an investor. As you said, there are lots of styles to this as well.
Yeah, the balance sheet point's critical there. If you've got too much debt in a rising rates environment when your margins are getting squeezed, that layer of earnings can disappear very quickly when you have operating leverage and financial leverage on top. It can get ugly fast. I mean, I saw Peloton has now raised debt. So that's the sort of the glorified bicycle with an iPad company that's gotten absolutely hammered since the pandemic because, lo and behold, not everyone wants, a fancy bicycle in their house with a screen on it, despite what the share price suggested. And now they're raising debt. Now like they could barely survive and now they're raising debt. I mean, that thing is literally the walking dead. So yeah, this is what makes single stocks for me so fun, but definitely not a bad idea to have some ETFs in the portfolio around that, just to keep your money ticking over while you have fun with the rest.
So I'm conscious that we've actually run out of time already, but I'd love to find out from you, since we've chatted last, any kind of new pearls of wisdom that you'd like to share. One key piece of wisdom that you'd like to share with someone listening.
This one's for the entrepreneurs out there who might be listening, because that's the group of people that I'm lucky enough to be part of now. And I must say the last 2 years has been the most insane personal journey. It's driven a lot of things to breaking point, but I think it's been well worth it overall. And I think the message I would leave has nothing to do with the markets. It has everything to do with any entrepreneurs who may be listening. And you touched on the concept of a moat, Warren. And I always say to entrepreneurs, your first moat is resilience. So if you are willing to just put in the hours and the hard work and believe even when there are many reasons not to, that's your first moat as a business, as an entrepreneur, as a founder. Beyond that, you've got to have a lot of other moats for sure, but there are so many people who give up before that stage. So if there's anyone listening who's struggling with a business or trying to get by in this crazy environment that we find ourselves in, just remember that the hard work you're putting in is why other people don't do it.
Yeah, I agree with that. I remember the first 3 years of our business's life, I asked myself almost every single day, why are we doing this? Will we get through this? And after 3 years, it felt much easier. And then people look at you after a decade and they go, oh, this entrepreneur thing is so easy. And they don't see the kind of quiet journey behind the scenes of all the pain and the angst of being the entrepreneur and believing only in yourself when no one else will. So I think it's a power point, that Finance Ghost. Thanks so much for joining us. I really appreciate you sharing your insights. I think the listeners always get great value out of this, and I wish you all the best in the next 2 years of your journey. And to all the listeners, I wish you all the best in your investment journey.
Thanks, Warren. And yeah, I'd love to come back sometime. I really enjoy coming on the show with you. Keep doing what you're doing. It makes a big difference to a lot of people.
Thank you so much. Thank you for listening to Honest Money. If you have any questions, you're welcome to reach out to me on Twitter. My handle is @WarrenIngram. Don't forget to subscribe. We're on Spotify and Apple Podcast. Chat soon.